Hi, and welcome to this week's look at the major stories affecting the market so far. And there's going to be a bit of a common theme this week, and it's going to be the Fed rate decision, of course. Firstly, we'll take a look at what the S&P was doing prior to that decision was made, sort of where anticipation was taking the market. Secondly, we'll obviously look at that decision itself and some immediate reaction. Thirdly, we'll take a look at how the dollar itself fared against a couple of other major currencies. And we'll finish off having a look at the reach, in fact, if you like, of that Fed rate decision and what happened and has happened to the Australian index based off the back of the Fed rate decision and other factors. So we'll start with the S&P 500. It actually set a new record ahead of that Fed decision. Now, as we can see on the US SPX 500 mini chart here at FXOpen, that's how we refer to the S&P 500. Tuesday saw an intraday high of 5678.9, passing the previous record of 5677.5 on the 16th of July. However, the bulls were not able to maintain that peak. Now, fears of recession back at the start of August led to a panic-driven drop on the 5th of August, and not just for the S&P, across the board, really. Now, August retail sales have come out, though, this week, and they exceeded expectations, supporting the view that the US is not on the brink of recession. Obviously, a bit of a fill-up to the market before that Fed rate decision came out. Pre that Fed rate decision, analysts were predicting anything between a 0.25%, 0.25%, 25 basis point cut, with some even suggesting the potential for a 50 basis point cut. That was certainly on the table. If we take a quick look at the chart, we can see that the market is in an uptrend. That's the blue channel you can see. And at the time this sort of happened, we were trading near the median line of that channel, suggesting there was a bit of a balance between supply and demand. Now, often those conditions suggest the increased chance of a flat market, but that was very unlikely with the Fed decision just hours away. If it led to a bit of a bearish news, we were looking for support around the 5400 level. But it's fair to say it pretty much was all about the Fed. Worth noting, Thursday morning, the index is trading around the 5720 mark, so you can obviously guess pretty much which way it went. But certainly, the S&P 500 was flying high pre-decision. So, what did happen? Well, the Fed decision came out and it was a 0.5%, 50 basis point cut. I mean, I think everybody, or the market participants, certainly felt that the cut was inevitable, but it came in at 0.5% and not 0.25%, which I think most people were expecting 0.25%. Now, according to Bloomberg, 10 of the 19 committee members supported this 0.5% cut. A few went for a quarter with a quarter later in the year, and some basically saying no further cuts at all. So then it came down to what was going to be said about it. Well, Jerome Powell, the Fed Reserve Chair, came out and stated that the cut reflects our growing confidence that we can maintain labour market strength amid moderate growth and a steady decline in inflation down to 2%. Pretty good statement for the market to hear. He also added, though, that interest rates are unlikely to return to the ultra-low levels we saw for many years before the pandemic. Now, off the back of this, what was the immediate reaction? Well, volatility unsurprisingly increased quite dramatically. Stock indices rose and the dollar strengthened slightly, but it was quite early and probably too early to determine a longer-term impact. If we take a look at, say, the euro against the US dollar chart, that shows that the ATR indicator reveals the Fed decision led to a volatility spike, though smaller than the volatility spike we saw back at the start of August with the panic-induced drops in Japan, the US, etc. And that was back on the 5th of August. So it does suggest that despite this increase in volatility, the market was prepared for news of this nature. Now, post-announcement, the price approached the late August high near the psychological level of 1.120, but it didn't exceed it. And the volatility spike also tested the September 13th low around 1.107. Now, Thursday morning, euro near that medium line of the blue uptrend channel, constructed using linear regression, and is in fact equidistant from the extremes set during that volatility spike. Obviously, we've got other factors coming into play as well, further interest rate announcements coming out. Again, though, the positioning along that median line suggests the market is relatively balanced as participants strive to better understand the longer-term implications of the Fed decision. So, certainly a spike in volatility. There will be volatility in the days ahead, so don't forget your risk management techniques. Okay, so let's take a look a little bit further at the dollar and its reaction to those Fed cuts. And trades were mixed obviously after that Fed cut. We know volatility was up. We've already talked about that in terms of the euro dollar. So what about other pairs involving the US dollar? Well, overall, the dollar initially dropped quite sharply, but it was followed by a partial recovery after comments from Jerome Powell that said the current decision would not dictate the pace of further cuts. I think some market participants were thinking, we've had half a point, we're going to have another one. Is there going to be further cuts later this year? So a little bit of uncertainty there. Take a look at, say, the Great British Pound against the US dollar. Hit a new high for the year, heading to 1.3100. US dollar against the Japanese yen, and that fell to 140.50 before strengthening back by more than 200 pips. And the US dollar against the Canadian dollar, that managed to rise above the 1.3600 level. Take a quick look at the US dollar against Japanese yen chart, and basically what we can see here is it's under dual pressure. We've got the Fed cutting rates, and we've got the Bank of Japan with plans to raise rates after a very long period of negative rates, and that is causing some pretty high volatility with daily ranges, in excess of 200 pips. So if you are looking at dollar yen, risk management is going to be very key there. Now, technical analysis suggests that the pair are undergoing a corrective pullback after forming a hammer pattern on the daily time frame. The rise was constrained by a significant resistance level at 144.00. That's been tested for a couple of weeks. Now, if that's not held soon in the next few days, we could see a return to 141.00 down to the 140.00 mark. There are some important upcoming factors to take into account with the dollar yen. The Philly Fed Manufacturing Index and initial jobless claims are due to come out. Well worth keeping your eyes on those. And on Friday, we have the Bank of Japan Monetary Policy Report, obviously going to be quite key. Take a quick look at the US dollar against the Canadian dollar chart. Now, Wednesday, that broke above the 1.3600 level and in fact tested 1.3650. Now, if buyers can maintain the 13600 down to 135.80 range as support, the corrective rise may continue towards 1.3800, 1.3700. If Wednesday's low of 1.3440 is revisited, the downtrend may resume with renewed strength. As I say, there is plenty of information still to come out, and we're still digesting, that Fed rate cut. So volatility could well still abound. Okay, and obviously, the Fed rate is the biggest thing to talk about this week. And we're going to take a look now at how far that decision has reached and impacts it's had. And the Australian S&P ASX 200 index hit an all-time high. As the Australia 200 chart, as we call it, FXOpen, shows, Thursday's candle surpassed the 8200 level, marking a new all-time high. That was driven by a couple of factors. One, unsurprisingly, the Fed cut. That led to a surge in volatility and set historical high records for gold prices, the S&P 500 and others, and obviously had a positive impact on the Australian index. Thursday also, there was positive news from the Australian labour market showing that unemployment has not increased. And in fact, the number of new jobs created in the month exceeded expectations. Actual came in at 47,500. The forecast was just 26,400. So again, a very positive figure. Those two combined, big fillip for the market. Take a look at the chart. That shows the price movement within converging trend lines. Now, the lower line was breached in early August amid that widespread panic sell-off that we saw in financial markets around the 5th of August. However, it's since resumed its role as support, and you can see that illustrated by the arrows. The upper line acts as resistance, and it's reinforced by the psychological level of 8200. Now, despite this, the price position near the candle's high suggests that bulls are showing persistence, at least for now. Could well try and drive back through that key level. Have a look at an indicator. Given that the RSI is at its highest level since early August, it's reasonable to perhaps anticipate that the current bullish sentiment may face increased selling pressures in the short term. So again, no definitives here. In fact, 8110 level could well act as support if we do see some selling pressure, having previously been resistance. So again, we're seeing all-time highs in several markets. We're seeing a lot of volatility. Don't forget your risk management techniques, and we wish you luck with your trading in the week ahead. Bye for now.